Good evening. I'm Peter Reznicek from ShadowTrader.net, and this is the Weekend Edition. In this video, I'm going to be talking about cognitive dissonance, especially as it applies to trading, and I'm also going to give you 3 specific strategies on how you can overcome cognitive dissonance in your trading. Let's begin with the definition of what cognitive dissonance is. Dr. Google, PhD, tells us that it is the discomfort a person feels when their behavior does not align with their values or beliefs. This is an excellent starting point, but in trading we know that it's a little more complicated than that. So I would expound on that a little bit in trading and expand it to say that in trading it's usually when you have the difficulty of holding 2 opposing viewpoints in your mind at the same time. And we all know that in trading, to be successful, sometimes you have to do that. So a very good example of that would be, for instance, if you are long-term bullish, for instance, but you want to make money in a short-term manner and you may be short-term bearish. You will often find that those bearish strategies are hard to execute properly because it's against the backdrop of that bullishness. So you're trying to do one action here, but you've got another thing in mind over here. So your action and your belief is definitely not in alignment. Another thing that's very common in trading is the simple fact that you may be long the market, but be thinking that everything's about to go to hell in a handbasket. And that is, of course, going to bring upon lots of anxiety for you holding those longs, because again, you're doing 2 separate things in your mind at once. What's even more common is that you want to get long because you see the market going up, but you just can't bring yourself to do it. So you often miss the move and you're not willing to just hold your nose and jump in, even though that is the exact correct course of action that you should be doing at that moment in the markets. And in trading, as we all know, unfortunately, this can get out of hand really easily because there's money on the line. Let's say that you're in a losing trade and it's going against you. You understand that the more it goes against you and the worse it gets, the more your brain is going to start to rationalize staying in that trade, right? What some people find themselves doing is, for instance, gravitating towards negative news flow or tweets that people put out that are generally bearish that may be supporting their short position, even though right on the screen in front of them, the short position is completely falling apart and it's just draining their account, right? But you find yourself drawn to that point of view that might be confirming your bias. And this is really the ultimate cognitive dissonance if you think about it, because in this case your action or inaction is really going completely in the face of what is actually happening in the market. You know that you should be covering these shorts, but you're just not doing it. Which brings us to the question, how do we fix this? And given what we've already learned about cognitive dissonance, there's a number of different ways we can attack this. First, change the thought. 2, change the behavior. 3, add a thought. Let's go into the charts together and I'll explain to you exactly what I mean by these 3 solutions and how you can apply them to your trading. Which brings us back to the market currently and what's been happening over the last couple of weeks, because we know that the market has experienced a lot of negative news flow, but hasn't really moved definitively lower at all. So let's look at the charts together and try to identify areas where cognitive dissonance was probably in play, and then we'll get into some of those strategies on how you can fix cognitive dissonance if it's something that's affecting your trading. Okay, let's look at some recent market action, which I believe has been very much causing a lot of traders to have cognitive dissonance. And if you recall in the beginning of the video, we talked about this is when you have difficulty holding 2 different viewpoints in mind. And in this case, because the market failed to go lower on all of these news events that I'm showing you on the screen here, such as the DeepSeek low, the tariff news, and the CPI news, which was just earlier this week, lots of traders, I believe, were caught off sides, meaning they have bearish thoughts against a bullish backdrop, or they may have also even been short. They probably were, lots of people short, and that is what's causing some of this very wild action right back to the upside, because simply there aren't more sellers behind the initial sellers who had the initial bearish bias on the news. There weren't enough sellers behind them to keep the party going. So let's look closely, if we could, at some of these areas here on the chart. As I was saying a second ago, this is the DeepSeek low, and these are daily candles of the ES, but they're 24 hours. And I wanted to specifically start on this chart to talk about the first potential solution to cognitive dissonance, which of course is to change one of the thoughts, right? Remember, there are 2 competing thoughts or 1 competing thought with 1 competing behavior. Changing one of the thoughts is a way out of this mess, right? So if you look at this chart here, what I really want to focus on is how you need to be looking at different signposts or areas in the chart that should be telling you whether or not you should change your mind. So the first thing you can do is, if you have something in mind, let's say bearishness. Obviously, it's against the backdrop here of a market that's having a lot of difficulty going down. But I do agree that some of the news that came out, such as the DeepSeek low, putting a lot of pressure on NVIDIA, maybe telling us that American AI was over, Chinese AI was going to take over, etc. Whatever the case, these were definitely negative news stories, and they definitely had negative effect on the market. The only problem was that they all had negative effect on the market for less than a day, right? It didn't really last. It was just overnight gap down and then go. So one of the ways that traders, I think, could have changed their minds effectively is if they looked at signposts ahead of time of what the market needed to do in order to maintain that bearish bias. And if you look at the chart that we're looking at here, just in the futures, the market never did that in terms of changing its bias. Like for instance here on the DeepSeek low, right? Notice that the move down here, and obviously, there are different time frames at work here, right? But what causes larger moves in the market is when all of the time frames start to align. So you have the very short-term time frame that may be selling the market overnight, that longer time frame that might be dumping stocks during the day, but then they have to reverse those positions, and that causes these sort of violent swings to the upside. So in order to be able to effectuate solution number one and change your mind, look at signposts on the chart and make the market show and prove to you that the bias that you have in mind is actually happening. And you can clearly see from this futures chart here that that simply was not the case. There was no situation here where you actually had a showing and proving of the market that it would actually stay bearish. Maybe on the DeepSeek low, you did go down here and you did close here, but notice where the market closed in relation to range, right? Let's just say that you were short somewhere on the DeepSeek low and you have, bad location here, for instance, or God forbid you're short somewhere near the lows. I'm sure some people were. Wherever you are, keep it simple, right? Where did the market close that day? If it's trading off of news that it thinks is very bearish, then simply take the range and divide it into 3 and ask yourself, which third did it close in, right? Like, where exactly did it close? And you can see here that it closed basically in the upper third. And if you were still bearish the next day, then you could also just say to yourself, okay, well, I'm still kind of bearish like the next day, but how deep did we come into that range? Not very, right about to the midpoint, right? So that would be like a nuanced level that I would be looking at. We call that halfback in market profile, and just say to yourself, okay, if the market can't even get past the midpoint of the prior day's range, which was the big bearish day when everybody was trading off of this news, then how bearish should it be? I should probably change my mind. And you can see this happen over and over in the futures chart over the last couple of weeks, where these lows have simply not held. Like, this is another perfect example here, in that you may be trading longer term, but if you have the ability to watch the markets all day long, then this is the type of information that you can use. Like, let's say I was only a longer term swing trader and I switched my bias to bearish on the tariff news because I thought, okay, this is something systemic, this is going to bother the whole market, we should go down a little bit, more than just one day. I either sell all my long positions or I establish new short positions, correct? Well, ask yourself this question. If you did that here on the open, this is when the futures opened, okay, there was an initial drive lower, but look at the prior low. It then took out that low, which is here for a very short time. I'm sure that this fictional person that we're talking about who's heavily short must be loving it. They're thinking, wow, we just took out the DeepSeek low. We are going all the way down to 5,800 more than likely. Well, if the market stops selling, and that can be for a myriad number of reasons, as I always like to say, it is always not because smart buyers came in. It is always only because sellers ran out of bullets. That's just how things work, right? There's no geniuses at lows. All right, all the geniuses are trading in the middle. Sellers simply ran out of bullets. Again, use signposts to your benefit and ask yourself, okay, if the market is really going to be bearish and stay bearish, then why did we come down below the DeepSeek low only a little bit, reject right away, and start to rally? And if you didn't figure it out then, I would hope that you figured it out by the end of the day, because look at the signposts that you've got here. You literally rallied back above the 21. So you didn't need to be short there at all by then at that point. These are just two examples of, like I'm saying, you want to be planning out these areas in advance of where you are going to change your mind rather than just play the hope card. The second way to fix cognitive dissonance is to change your behavior. And for that, I've purposely switched us over to the S&P instead of the futures market, because I believe that most people actually trade in the regular trading hours session. And most people also are not actually futures day traders or watching every tick or really even knowing the structure of what the overnight situation looks like, right? Or of what the overnight inventory or what the overnight distribution, if you will, of where those prices were overnight. A lot of traders who focus just on equities don't know this. So for that reason, I wanted to talk about this second way to fix cognitive dissonance, which is to change your behavior in the context of daily S&P chart. So relatively similar to everything I was saying before, just using these same three examples. Here we have the DeepSeek low. Let's just start with that one, right? A simple thing to think about might be, okay, so I've initiated a short somewhere here near the open. That obviously is not working very well. The market opened and started going back up. This is the cash market. What about using this 21 EMA right here, right? Okay, well, why did we start to find acceptance above the 21 EMA, right? But maybe could still go lower. Here you found acceptance back above the 21 and the market clearly went lower. So, you just start looking basically. Doesn't mean you're going to change your behavior right away, but you start accumulating data points as you go that are going to eventually make you change your behavior when enough of those data points flip into the other column, as opposed to changing so that you potentially, I should say, try to change your behavior earlier as those data points start to stack up, as opposed to changing your behavior if you're short all the way up here, which obviously is the worst possible time, and you've already blown out your account by then, right? That doesn't make any sense in a sense. So let's continue on and just stack those data points, right? This would probably be your first data point if you were just trading in the cash market of moving back above the 21. And again, in this sort of fictitious example, let's say that you remain short. You're a big believer that the DeepSeek thing is real. It's going to be negative for the market. It's going to stay negative for the market. I should probably stay short. Okay, well, just go to the next day. Now you've already accumulated one data point in terms of going above that 21. Here's a second data point. The next day, when the market opens here, you still remain short, but then it starts pulling back, right? You have this move lower. And again, this is now helping your position and you probably feel better about it, but you need to be watching those signposts, because on that particular day, it's not a coincidence that where was the low? Right back to the 21, right? This is the 21 exponential moving average. Keep it simple, as I always say with your TA. 8 EMA, 21 EMA, trend lines, prior highs, prior lows, balance areas, that's all you need. No indicators, no nothing, keep it simple, right? So now you have yet another data point that you may be thinking, okay, you know what? I probably should change my behavior here and get out of these shorts or get into some longs. And you can see that those data points, as the market moves up, just keep on stacking, because then we cross the 8, right? And then the next pullback is even more shallow, and on. And the next thing you know, like I said, you filled the gap, and there are plenty of people probably who are covering at the wrong time all the way here, on this open or whatever, because they aren't paying attention to these signposts and are not thinking in advance of where the levels are, where they're going to simply change their mind or change their behavior. As I was saying in the beginning of the video, the third answer to cognitive dissonance, or way to change, is to add a thought, which of course is different in trading, and I'll tell you exactly what that is. But in the classic example that everybody always gives about cognitive dissonance, they always talk about people who smoke cigarettes. That's their action, but on the other hand, they know that it's unhealthy, right? So these things are at odds in their mind, and that's cognitive dissonance. And the solution to that, using point number 3, is to add a thought, where in the examples that they always give, the person could say, well, I know I'm going to die anyway, right? So that adding that third thought in definitely sort of lessens the dissonance of that you're currently facing. So in trading, as I was saying, because everything is slightly different, I would call it add a trade instead of adding a thought. A lot of people don't think of this when they've got their whole portfolio, going in one direction. Why not hedge or start to put things on in the other direction that are going to alleviate that pain if it happens? And again, at the same time, you should do this by using these signposts that we talked about. So going back to the example of the S&P, crossing here why not just buy a little bit of SPY long, right? You can easily look at your portfolio and see what your total short deltas are, right? So you would have negative delta because you're short. You may be short a lot of stocks or futures or whatever. You don't need to hedge off all that delta, but take some percentage of it, right, at the different signposts. So for instance, maybe right here, if you want to stay with the position, you may buy 25%, meaning that you would, whatever your deltas are that you're short, you would hedge those deltas by 25%. And maybe when it gets a little higher, you may hedge those deltas by 50%, right? And when it crosses enough signposts where you're like, okay, now I definitely know that I'm wrong, right? And again, that all depends on your time frame outlook. Maybe you just go fully into that SPY long, or at that point you just dump all of the shorts and take that pain away, and you've now cut down those losses by quite a bit. And if you want an even more advanced heads up, or sometimes very often a faster heads up to what the market is doing to make you change your mind or change your behavior faster, you really should get into Market Profile, because this is where you see nuances that other people just don't see on the charts. Some of these nuances you could mark off on traditional charts, but some of them simply do not exist on traditional OHLC or candlestick charts, and that's where the profile really shines. So talking about the same exact examples that we just looked at in the regular trading hour charts of the S&P and of that 24-hour chart of the ES, let's look at how some of that stuff looked like in the Market Profile. So going back here, this would be the DeepSeek low right here, right? And this activity right here is the overnight activity. And we know that the market gapped big time on the DeepSeek news, but it did not follow through. So the first thing you want to note is, well, where exactly is this overnight activity? And once the bell rings, all of the overnight activity has already finished, right? So we do have some good piece of information about that overnight activity. For instance, we know where, for example, the midpoint of that overnight activity was. And in this case, it's this yellow line here. We call that overnight halfback. So you know right away where the midpoint of the range was. Now just think about this rationally. If a market is going to be bearish and stay bearish, then the next session, which is the RTH session, probably shouldn't be finding acceptance above the midpoint of that bearish session, which was the overnight session, right? If it starts going over the halfway point, well, that's obviously the tipping point where about 50% of the people start changing their minds, right at the midpoint of that session. So that to me was an obvious kind of red flag right there that the short side wasn't really working. And these are things not only that I point out pre-market in my pre-market perspective newsletter and video, which comes out every morning, but things that I talk about when I'm trading live with my group in the weekly options advisory. This is essentially what we spend the first 2 to 3 hours of every session doing together, is going over these nuances, and I'm pointing them out in real time, constantly shouting out things like, hey, we're starting to find acceptance above the midpoint, or hey, look, we're coming to this point of control here, or we have failed to reach this point of control. The market has come down, but it has not touched the point of control, so we know that those stronger sellers just aren't there or whatnot. And that's the type of information that is extremely valuable when you're trying to figure out what bias you should either maintain or change. So going back to the chart, we did not hold that midpoint, and we started to find acceptance above. That's definitely a tell right there that the market is not as weak as you would be thinking. One of the other things to note right away is that you know that the market opened here, which was at the green dot, right? And you know that all this overnight activity goes down way down here. I'm not going to move the chart because I don't want this little circle to change. I want you to focus on the fact that that's the open. Well, right off the bat, how many ticks did the market actually go down in the regular trading hour session? About 5, like basically this, and it just took off. That's a sign as well. If the opening drive is higher and it doesn't turn around relatively quickly, it's probably going to keep going and go for a gap fill. Dalton always teaches this in the gap rules that he set up, and gap rule number 1 is go with all gaps that don't fill right away. That means that you would go in the direction of the gap if it doesn't start to fill right away. That means that had this opening drive been lower, you would be right to short, right? You go with all gaps that don't fill, it would be like this. But this gap did the opposite. It actually started to fill right away. So why would you want to be short, right? Right at that green dot, it went immediately. And already, before that market even opens, you already have a huge piece of market generated information. If you look at the charts like this on this more granular level, you know where the market is opening, in relation to the overnight range. And you know that the overnight low, as we call it, the ONL, is way down there, and a more bearish market would certainly open closer to the overnight low than this market did. All right, moving on, if you look at some of these other lows here, there's plenty of signposts always telling you that you should be changing your mind. As you know, that was the DeepSeek low. This is the tariff low, same exact thing. The market was weaker in the overnight session than it was in the RTH session. This little green dot, I know it's a little bit faint, but if you can see it, that's actually your open. And what would you be doing in terms of changing your mind or changing your behavior? You would be watching this open, which actually was a bearish open, right? It did move down, but if it was to move down in a stronger manner, in a way that would keep the short party going more than just in the overnight session or just one day or a half a day or whatever, ask yourself this question: why didn't it take out the overnight low? Why did the futures market go only to here and turn around? Because simply in the longer time frame that was longer than, you know, trading off the open or algorithms or whatever, the stronger sellers weren't there, right? The sellers that would have gotten into a short position and held it, they simply weren't there. And again, it's just off to the races, right? And we see these single prints here, which is another market profile nuance that regular charts don't have, which tells us that there was an immense amount of emotion almost all the time when the market gaps down low and you see those single prints. That is a sign of reckless short covering. It tells you that the shorts are very nervous and they're hitting the button hard. And when you see those single prints, even that is a signpost that should be telling you, hey, I may want to change my behavior or my thoughts here, because obviously a lot of stops just got triggered and the market's probably going to move higher from here. And if you just keep going on with the profile, even all the way to current day, you just keep seeing these areas over and over and over, right? That particular area we just talked about, which was very emotional, it left single prints on the market, right? The single prints are a sign of bad structure over where people traded very emotionally, and usually those areas get repaired. But again, using the signposts to tell you if you should change your mind, in this case away from bearish, what happened the next day? Did they revisit the single prints? They did not. The market actually opened right about here, which is actually quite noteworthy because it opened at the prior day's settlement. And guess what? It only goes down to here. And what happens when it crosses the settlement? We call that screens go green, right? Everybody in the world sees the same thing. And look, the market goes green very quickly because it is now above the prior day's settlement. And boom, everybody's trading off that market generated information, seeing that the market has now changed tone and is actually green very, very early in the session. And again, you can just go on and see these signposts over and over as it keeps happening, even right up to this week, which was the CPI print that the market didn't like, right? Same exact thing. You have an overnight situation here, and yet where do you go in the RTH session? You do not take out the overnight low, right? And you just start turning right away. And that, you know, when these things happen early in early trade, this is where you can really not only change your bearish position or your bearish mind quickly, you can make a lot of money here with a relatively tight stop, because you can be looking at these areas as areas in advance and saying, okay, you know, I know we didn't take out the overnight low. Let's say if we get strong here, we go back to the open, that's going to be a buy for me, right? Maybe not just like cover your shorts or change your mind, but actually buy the market. And depending on your time frame, you've got to stop right here. So if you have a long enough time frame, that may actually make sense. I mean, you're risking about 10 points there, and maybe that may be too much for an intraday daytime frame trader, but for somebody who looks at the market on a longer term basis, they may weigh these odds of this risk reward and say, yeah, you know what, I can risk 20 ES points here because the upside may be 40, 50, or 100 ES points. So think about that as well. You can use these signposts in a very nuanced manner that way, okay? And again, like I was saying, just off to the races, and it just keeps happening over where, for instance, like this day here, which was on the 13th, you opened right about here and you went into range, right? And yet when you go into range, remember, in order for the market to move lower, you need what we call acceptance, which means that you have to spend time inside of range. So look at where you opened here at the green dot, which is just inside the upper part of the prior day's range, almost at the top. and then the market collapses and it does something relatively bearish because it goes into range, right? But the single prints here, the fact that this is only one set of TPOs, we call these TPOs or time price opportunity, and it's only the letter B, meaning that it designates only the first 30 minutes of trade. I start the profiles with B. So from 9:30 to 10 a.m. Eastern, it's printing the letter B. Well, if it was bearish, why wasn't there more acceptance? Meaning C period, D period, E period. Why didn't these letters start to stack up next to each other like this and have acceptance in the prior day's range, which would be weaker? Instead, we just went in, a little bit of price exploration into range, rejected right back out, right? A classic thing that we talk about all the time in the room, I've probably pointed this out thousands of times. Not everybody, but lots of people make money from it, or they change their mind very quickly, is the fact that as you were coming down that day, you had a classic taper of volume and a very low number at the bottom. Very, very often when that number of contracts traded goes down below 100 and you see above it that you have at each subsequent price level above it as you're coming down, those numbers are tapering. I call that the taper. When those numbers are less than 1,000 contracts and you are as the market's coming down, notice that right about here, it essentially stops printing 4-digit numbers. As the market's going down, then you print a couple 4-digit numbers here and just one here, and the rest is all 3-digit, and then boom, you end right there on that 12. And again, using market generated information to your advantage to try to figure out when you should A, change your mind, B, change your behavior, or add a thought, which in this case, as we were saying in trading, is add a trade, right? So again, if you have market profile on your screen or you're following me during the day, as I share the profile all day with everybody in my room so they can see it for free, and also pointing out these nuances as they're happening, that's a signal, right? This is very, very common in my room. I've probably, again, posted this 1,000 times saying, hey, heads up, 12 contracts at the low, taper of volume. Boom, that's it. That's all you need to know. 12 contracts at the low, taper of volume. Huge odds that the low of the day has been put in. And again, in the bigger picture, you're going to be asking yourself, okay, if I'm bearish here and we've come into range, why did this dynamic just happen? Why did we just taper volume coming down and print 12 contracts at the low if my bias or thought is that the market's going lower? It's not happening. So use these signposts all to your advantage, I would say, as much as you can in your trading. And that's my discussion on cognitive dissonance, but more importantly, how to overcome cognitive dissonance in your trading. And if you were listening carefully, you probably noticed that those 3 solutions that I gave you all hinge on one particular thing. And that thing is identifying areas in the market where you should be changing your mind or changing your behavior instead of just playing the hope card. And remember that those different areas where you change your mind or your behavior can be very varied. They can be trend lines, prior highs, prior lows, or even more nuanced market generated information like I showed you in the market profile, but they also have to align with your time frame. So remember, if you're a very long-term trader, those signposts may be trend lines or prior highs and prior lows on monthly charts. Medium-term traders might be using weeklies or dailies, and very short-term traders might be changing their behavior or their thoughts using charts as low as, say, 1 minute and trend lines or prior highs, prior lows on those particular charts. So it's really, really important to understand that it all boils down to having the information in advance, seeing it, knowing where it is, and then just setting rules for yourself and saying to yourself, okay, when and if we cross this level, then it's going to require a change of mind or change of behavior. As always, if you'd like to get deeper into what Shadow Trader has to offer, check all the links down in the description. We've got 3 different trading rooms at shadowtrader.net, all of which deal with different types of trading styles. We've got everything from swing trading to live futures trading to weekly options trading and everything in between. There's always $7 1-week trials to all of these rooms, and as always, Shadow Trader always has a one-click cancel policy. So if you take a trial with us, you never need to call us or email us to cancel that trial. You just do it yourself with one click on our site. All right. Remember to hit that like and subscribe button on the bottom, and also the little bell icon to be notified whenever Shadow Trader posts new content. Coming at you from beautiful Los Angeles, California. As always, I wish you good trading and good night.